Hello, and welcome to today's tutorial on how to use Bollinger Bands and TradingView, brought to you by Optimus Futures. Bollinger Bands are a powerful volatility indicator that help traders identify overbought or oversold conditions and potential breakout opportunities. So, what do they measure? Well, Bollinger Bands consist of three components: a middle band and an upper and lower band. Now, the middle band is simply just the 20 period simple moving average, as shown here in light blue. The upper and lower bands, as shown here in white, those plot out a certain number of standard deviations above and below the SMA, typically two standard deviations based on whatever price you choose, which is usually going to be the closing print. Now, because the bands expand and contract based on volatility, they visually show you how much price is deviating from its average. So when the bands widen, volatility is increasing. When they tighten, volatility is decreasing. And decreasing volatility may often be a clue that a strong move may be in the works. Bollinger Bands can be traded as a mean reversion indicator. That means that as price moves further away from the average, it's more likely to move back towards the average. So you can play counter signals. So, for example, when price goes up and touches the upper band, it suggests that it may be overbought and momentum could soon fade and reverse back towards the average. Conversely, if it moves towards the lower Bollinger Band, it may be oversold and maybe soon working its way back up towards the simple moving average in the center. So traders may naturally try to go against the grain as it moves into the overbought or oversold conditions. However, it's important to note that overbought doesn't always mean sell and oversold doesn't always mean buy. In strong trends, price can ride the upper or lower band for extended periods. You can see here how strong price action caused price in the ES futures to ride the upper Bollinger Band through the entirety of the main trading session and only deviate once it got into the overnight hours. That's often why traders will confirm signals with other indicators, such as the RSI, the relative strength indicator, or the MACD. Now, another popular approach is to use what's known as a Bollinger Band squeeze. This occurs when the bands contract tightly around price, signaling extreme low volatility. Traders watch for a breakout above or below the bands to indicate the next potential expansion in the trend or move. So, for example, we can see how price contracts here, as do the Bollinger Bands, and then we see price expanding in the same trend that's been continuing and moving upwards. And they may, as a trader, try to follow that trend. Now, it's also worth understanding how these contractions and expansions occur, because during an expansion phase in ES futures that occurs during the main session, you're more likely to see a contraction during the overnight session. That doesn't necessarily indicate that a big expansion is going to occur, but rather is just more indicative of how trading happens in the overnight versus the daytime sessions. So let's take a look at what this might look like from a potential trade opportunity. Now, down here we have gold futures on the 1 hour chart trading in what is a narrowing band. You can actually see as we get to the close of the main session here in early November, you start to see price expand into the evening hours and through Monday. This is where you would have a potential contraction in the Bollinger Bands that leads to the next expansion. And you'll notice the Bollinger Bands widen as volatility widens. Once the move is complete and price starts trading sideways, the Bollinger Bands start to squeeze together. Now, some traders may also look for mean reversion setups. Essentially, what they're going to do is as Bollinger Bands trade against the upper band, as price trades against the upper band, they're going to look to fade it and short, or if it trades against the lower band, they're going to look to buy it and trade long. You can see that here where you had a lot of mean reversion potential trades where price traded against the upper band, pulled back, same here. And we saw the same thing as it got below the lower band. It pulled back towards the upper band and kept doing that. It works very well in sideways price action, but can run into some issues when you are in a trending environment. So to add the Bollinger Bands to your chart, all you simply do is go into the indicator and type in Bollinger Bands. And you'll see that you get a Bollinger Band as a potential opportunity that you can add in. And you add it, and here I have it set up. In the settings, I've colored mine slightly differently, and you can change the inputs for the length. The length will allow you to determine how much it responds to the price. The shorter the length, the more responsive it is to price, but the more noise you can get. You can also change to other types of exponential moving averages, weighted moving averages, and you can also change the source, whether it's the open, high, lower, close, or some other items. And you can include an offset as well. Well, that's it for today's video on trading with Bollinger Bands and TradingView. And remember, there is a substantial risk of loss in futures trading. Past performance is not indicative of future results. Please trade only with risk capital. Thank you for watching, and we'll see you all in our next tutorial video.